What's up, guys? I'm Mike from StockedUp. In this video, we're going to be talking about market maker expectations. We're going to be talking about how standard deviations and options pricing works. And I'm also going to be giving a couple tips and tricks I have if you don't want to go through the hassle of, using standard deviations or using some advanced probability methods and things like that. There's a couple tips and tricks that can make this whole process a little bit easier. So stick around to the end of the episode. We're also going to be doing a small recap on the small account growth challenge. So make sure you stick around. So let's get right into it. So let's talk about market maker expectations. So I'm sure a lot of you have either traded an option before or heard of someone who might have bought like a call, for example, and then the stock goes up, yet the person still loses money. So in the options market, not only do you have to predict the direction correctly, you also have to get the timing or like the time premium right. So predicting the direction is not enough when it comes to the options game. You also have to have the timing right. And this goes hand in hand with the market maker expectation. So for example, if we go back a couple weeks with Tesla earnings, I know a lot of people played calls and puts on Tesla, and calls and puts both dropped in value after Tesla reported earnings. And this is because of market maker expectations. So this is what we're talking about. Pretty much before Tesla reported earnings, the market was expecting like a 12% move to the upside or the downside. And that's crazy, like a 12% move in one day just on Tesla. And what ended up happening is, Tesla gapped up when they first reported earnings, and they ended up falling, and they were down overall a decent amount. Like it might have been, let me see, it might have been, here, let me get this drawing tool real quick. But the bottom line is, look at Tesla fell on earnings, but they didn't fall enough. They fell about 4% on earnings, right? And puts still dropped in value, and that was because the market makers were expecting like a 12% move or 10% move in one day. I don't remember the exact number, but the bottom line is market makers were expecting a crazy move out of Tesla, and Tesla didn't really move, so calls and puts fell. So in this video, we're talking about this exact topic. So why does this happen? The first reason is because of implied volatility. IV, you can call it too. Typically when IV is high, options get very expensive and the market maker expectations get very big. It means people are very, I don't want to say uncertain, but people know that volatility is coming for the stock. So people know that a lot of crazy things are going to happen. The stock's about to move big. When IV is high, that means options are expensive, and typically it's better to short options or trade credit spreads. However, when implied volatility is low, it is better to long options because the market is expecting less of a move, so it's easier to profit. So that's how it works, and I'm sure a lot of you are like, how do you define high or low implied volatility? And my answer to that question is that it is relative. Some stocks are going to have very low implied volatilities, like Verizon, that only has a 19% implied volatility that you can see at the bottom right here. However, some stocks like Tesla are going to have a 75% implied volatility, and I would consider both Tesla and Verizon to have low implied volatilities right now. So what I do is, because every stock is different, I like to look at the implied volatility relative to where it has been, in the past. So we could see the IV on Tesla right now is at about 75%. A couple months ago, it was sitting around 186%, and a couple weeks ago, it was sitting around 135%. So I like to look at it on a relative scale. Verizon, kind of the same way. It's sitting at 20% right now. A couple months ago, it was sitting as high as 70, almost 80%. So you just have to look where it is now compared to where it has been. If you ever took a statistics class or anything like that, you probably have heard about the concept of standard deviations. Pretty much what this is there is a distribution model. So if we go to standard, standard deviation, perfect, like this. So if we go to a chart hold on, let me go back. So if we go to images on Google right here, we can see that there is a model right here, and pretty much it just like plots the distribution percentage, and like it's used a lot in math and obviously statistics, but it's also used in the stock market. So pretty much how it works is the market or the options chain gives everyone an expectation. So if we go to like Facebook, for example, Facebook stock right now is at around $261. On Thinkorswim, we could see that the market maker expectation right now is around $10.21. You can see this by going to the options chain and seeing the $10.21. What this means is that the market is expecting a 68% chance, or one standard deviation, of Facebook being between, so if we take the current price of $261 and we subtract $10.21, there's a 68% chance of Facebook being between $250.79 and $271.21. Now, if you want to take, two standard deviations, then you just add like another $10.21, and then the probability gets lower and lower. So I'm not going to explain how a distribution model works, but pretty much what happens in how to make use of this is you have the market maker expectation and you have the current price. You take the current price, you add the market maker expectation, and then you subtract it. That'll give you a range like we just saw. We have 271 and we have 251. So there's a 68% chance of the stock being somewhere between those levels by the expiration date. So I'm sure a lot of you are like, yeah, that's cool, but how can we use this and how is this relevant, right? So if we go back to the notes right here, there are, mainly 3 standard deviations. Technically, you can go further on, like 4 standard deviations or even 5 or even more, but typically, there's really only 3 that are used. The first standard deviation, there's a 68% chance of the stock falling within that range. Second standard deviation, 95%. And the third standard deviation is a 99.7% chance of the stock falling between that range. So you can do your own calculations to see where the stock will go, but by using standard deviations, you can get a general area on where the market is expecting the stock to be. So if you think that Facebook is going to have a crazy explosion up to $270 this week, if the market is not expecting that, and Facebook actually does explode, your calls will explode. However, if Tesla or if Facebook is expecting an easy move up to 270, and you also think Facebook's going to go to 270, then maybe buying call options would not be the best way because the market is already expecting that. In that case, you would want to sell like a put credit spread or just sell puts in general. So I know this is a very advanced topic, but if you have like a background in math, you should definitely understand this a little bit easier than someone who this might be like a first time learning it. So there's a lot more information like on Investopedia.com. They explain this great, but some tips and tricks if you don't want to do any of that math with the standard deviations. Pretty much delta is kind of like, I don't want to say a cheat, but it's a nice tool. So all options have what's called like a delta or theta or gamma or vega, like options Greeks is what they're called. Delta is one of the options Greeks, and if you take the delta, it can give you a rough estimate. Like I said, this is a rough estimate. It is not crazy accurate. It's a rough estimate of the probability of that option expiring in the money. So if we look at Facebook right here and we see the 265 strike call option, you could see that the delta is 38 cents. So that means that there's about a 38% chance that this option will expire in the money. It's a rough estimate. It's not crazy accurate, but it's a general idea. Like if we look at the 270 call, there's about a 23% chance of that option expiring in the money. If we look at the 250 put, we can see it's 0.17 or negative 0.17. That means there's a 17% chance of this option expiring in the money. Like I said, it's a rough estimate. It is not like that accurate. It's just like a rough estimate. And then also you could use the market maker moves for if you want to do the math manually by plotting the standard deviations and seeing what exact percentages Facebook or any other stock is actually expected to move for the given time frame. But that requires more math skills. And then last but not least, if you are in Thinkorswim, you can actually get the exact probability of a stock going at what price at a certain time. So if we go to the Analyze tab, we can see that you just input your stock price, you go to probability mode in the money, and you put in your range. So for example, for the first standard deviation, we could put in 68%, and you can see where Facebook is likely to be by at what date in the future. So we can see that there is, like, if we go to, I don't know, let's say if we went to like 20 days out for, let's say September 4th, right? We can see that Facebook has about a 25% chance of being below $245 and a 75% chance of being above that. You can use any level, you can use any date, and it will give you that. You could use any probability range, and it will let you know how everything is expected to perform. So, you can mess around with it. I know there's a lot of other great tools on options trading platforms. I think it's like Tasty Trade or Tasty Works, it's called. So I know they have great tools for options trading. Personally, I love Thinkorswim, and I really encourage everyone to mess around with this probability analysis tab. You can type in any stock. You could type in, really any date pretty much, and get a probability of where that stock will be. So I hope this video. We have to go over the Robinhood account. So with the Robinhood account, the small account growth challenge. Let's load this up. So it's a very slow week, and really, I've really only been playing credit spreads. I'm gonna go over the history. Let me go over the history real quick. So I traded 2 FedEx call credit spreads this week. They both won. Let me go to FedEx call credit spread. We had let me expand this. We had the 220 and 215 calls. Got a credit of 16, and then we did that again and got a credit of 10. I closed the first one out, and then I held the second one to expiration. In hindsight, I should have held both of them to expiration. I would have made a couple dollars extra. But really, the small account is growing really slow, right? And we definitely need to get the move on with this because we wanted to grow it to 5,000. So I had it. Let me see. Yeah, so we started at about $1,000, and we had it all the way up to highs. It was actually above this. It was actually like over 1,100 with TLT, and I had TLT calls, and that ended up reversing. I ended up cutting, right? So I'm glad I ended up cutting, and I've been doing call credit spreads right now. But really, I think the best way to grow this account, the way we want to, is to do a little bit more day trading. And the problem is with Robinhood, I've been having a lot of problems getting filled. Like, I have to submit a lot of orders just to get filled how I want to get filled. So I'm strongly considering changing the brokerage from Robinhood to Thinkorswim or like Tasty Trade or Interactive Brokers even, or even E-Trade. I'm considering changing the brokerage because Robinhood is really hard to get filled on. So obviously with growth like this, it would take forever to grow to $5,000. So obviously we need a lot more growth. Like the first couple weeks were really solid, but then TLT reversed, right? But overall, definitely has to grow a lot more, or else this challenge is going to be going on forever, and no one wants that. So I'm really considering changing brokerages just to get that, the account off the ground. You know what I mean? Because it's growing just a little bit too slow. Like, yes, is it growing? Yes, it is growing, but it should really be growing a lot quicker. So I'm really considering changing brokerages. If I do, I'll let everyone know. But really, I've just been sticking to credit spreads, really safe credit spreads. Like I said, I traded the FedEx call credit spreads this week. Ended up working out good, and I'm probably going to trade credit spreads again next week unless I change the brokerage. In that case, I'll definitely do a couple day trades. So if you guys have any questions, let us know in the comments down below. But other than that, thanks for watching.